According to Jim Rickards, a well-known investor, there will be a major collapse. This is bound to happen with the chaotic combination of overly optimistic thinking, refusal to accept specific issues, and procrastination. With this, the government will act with executive orders. Consequently, there will be times of social unrest and a form of neo-fascism is predicted to emerge. Furthermore, more experts are starting to believe that people might lose trust in the US dollar and even the whole global monetary system in general. As you know, the global monetary system revolves around the dollar, so if it loses its value, the entire structure will crumble. We don't intend to provoke and cause panic, but there is historical evidence that demonstrates how the international monetary system collapsed. This happened 3 times over the past century, one in 1914, 1939, and in 1971. With that, we may have the 4th collapse within this century, proving that this phenomenon is not as rare as we thought. Hello and welcome to Eminent Investments. In today's video, we'll talk about Jim Rickards' comprehensive analysis of the incoming economic catastrophe. It's an interesting topic, so make sure to watch the entire video. Before we get into it, do give us a like and subscribe to the channel while you're at it. If you're done with that, then let's get started. When the monetary system collapses, it's not exactly the apocalypse scene that you're expecting, where everyone falls back to their primitive states. No, instead, financial and major economic powers convoke to bargain the terms, basically reconstructing how the game is played. Given the possibility of experiencing this collapse, you might ask, what are the new rules of this game? In the face of a collapse, what would the future monetary system look like as the consequence of a modified Bretton Woods-style conference? With this, Rickard talks about 4 specific scenarios that might happen: various reserve currencies, SDRs, gold, and an impending collapse that will be followed by a messier event. Let's talk about various reserve currencies. In the year 2000, the International Reserve held 70% in dollars. However, at present, that's down to 60%. It's plummeting through time. Just think of a reality where this eventually falls at 50%, or even lower at 45 or 40%. After that, the euro's value will probably increase. As you may already know, the Canadian and Australian dollar were only recently acknowledged by the IMF as the official reserve currencies. Technically, they have more power, and this will soon lead to a situation where you end up with plenty of reserve currencies. This is what Rickards calls the kumbaya solution, where everyone just goes with the flow. However, he stresses how this won't be possible because it's too unstable. It has no common goal, no gold, and no dollar. With this, instead of having one bank that behaves erratically, you'll have more to worry about. This will only worsen the situation rather than alleviate the currency wars. Next, Rickards highlights that elites have a penchant for this. When he says elites, he doesn't mean some kind of secret group. He's talking about central bankers, finance ministers, academics, treasury secretaries, and other policymakers. This is the SDR, which is a special drawing right. Only a few people understand how it works, despite it being very simple. One simple way to comprehend it is basically knowing that the FED has a printing press, and with that, they can print their own dollars. In the same manner, the European Central Bank also has a printing press and they can print euros. The IMF also has one, enabling them to print SDRs. Basically, that's what makes up world money. It's up to them to print as many as they want, giving them the power to reliquefy and reflate the global economy. In connection with this, the IMF is already formulating a 10-year plan to grant the SDR as the global reserve currency. This is no secret, and in fact, this is actually out to the public on their website. Rickards also asserts that the SRD is already easing its way into our system. To explain the situation, he says that back in 2009, the United States Treasury was given the power to distribute $100 billion. You might be wondering, what did the IMF do with that money? If you take a look at their credit lines and loans, you'll see that 90% of those were sent to bail out Mexico or Europe. What the rest of the world received was a mere 9%. According to Rickards, the president was far from candid when he said that this had to be done, because emerging market economies need development. Other nations like Korea, India, Indonesia, Malaysia, Thailand, and Brazil don't get more than 9% of the IMF money, and this raised a lot of concerns. If American citizens were more aware of this, then this might lead to a chaotic turn of events. Now let's talk about the third scenario, which centers on the gold standard. Basically, a gold standard is an established relationship between physical gold and paper currency. However, when it comes to setting up a gold standard, a few concerns have to be addressed. First of all, the definition of money must be discussed. There are many technical definitions out there, namely M0, M1, and M2. These amount to various measurements of money supply. Second, finding the correct reserve ratio is essential. This ratio helps us determine the amount of gold necessary to support the paper currency in circulation. Gold bugs, the upholders of the gold standard, insist on a 100% reserve ratio, which means that there must be 1 unit of gold backing every unit of currency. However, based on historical evidence, gold standards will only succeed if it operates on a lower reserve ratio. England, for example, sustained a lucrative gold standard back in the 19th century, and it only had a 20% reserve backing. Meanwhile, the United States used over 40% backing in the majority of the 20th century. Lastly, we have to address the concern of which countries are to be involved in this gold standard system. Although the United States can carry out a gold standard by itself, doing this exclusively has its own consequences. If the United States exclusively implemented a gold standard, its currency would consequently look attractive to many, making other currencies worthless. With this, deflation and economic instability will occur. With those criteria being mentioned, let's talk more about the gold and where it is. In the European system, there are 17 members and they all back up the euro. They hold 10,000 tons. The United States has about 8,000 and the IMF has 3,000. Luckily for Europe and the US, they still have all their portion of the gold and they're the biggest holders so far. However, when it comes to international conferences, China is probably close to 4,000 tons, but at the moment, they have barred theirs at 1,000 and have not updated their figures so far. Rickards believes that China is extremely powerful in this aspect. Now let's head back to the last scenario, which is the impending collapse. Rickards claims that this is most likely to happen. He predicts that we will simultaneously experience both inflation and deflation. The deflationary aspect is inevitable because it naturally arises during a time of depression. Deleveraging triggers this. The latter is urging people to sell their assets to pay off their debts. However, this only builds a cycle of debt-driven deflation. As this goes on, people will sell more and more assets just to pay off their debts, because the prices are consequently going down. Although inflation and deflation cancel each other out, one will always prevail, making the so-called equilibrium unstable. The monetary policy roots of this are linked to the basic thought of the quantity theory. Here there exists the equation MV equals PQ. M represents the money supply and V stands for velocity. If your money stays put, there's zero velocity. However, if you give a tip when you go to the bar, the bartender will take that and use it for the taxi on his way home. With this, that tip will have a velocity of 3, supporting the purchase of 3 goods, which are the tip, the taxi, and the gasoline. Now if you multiply $3 trillion with 0, you'll still have 0. In simple terms, if velocity doesn't exist, the economy won't as well. Technically, money supply is the amount of money existing multiplied by velocity and how fast it's being turned over. This results in the nominal GDP, which has 2 parts. Q, the real part, and P, the price index. However, you must know that the people in charge bend the velocity curve to urge you to spend. Doing so will earn them the nominal growth that they can use to pay off the debt. They will use propaganda through negative real rates and inflationary shocks. This is the FED's discrete objective. With this, Rickards reminds everyone to comprehend the intentions and reasons behind the FED's actions. If we're vigilant enough, it'll be easier for us to predict their future monetary policies, which they will most likely intensify until they attain their goals. Well, that's about it for today's video. If you liked our content, do give us a like and subscribe to the channel. Once again, this is Eminent Investments. Thank you for watching and we'll see you next time.